This conference will now be recorded.
Good morning, everyone. Thank you for joining us for another webinar presented by TrueUnion. My name is Sally Carruthers, and I am the CEO President of TrueUnion. And I thought today we would run through basically the last 18 months and counting and what we've learned from appraising in a pandemic. Realize that this is a ever-changing situation, and kind of just as a bit of commentary, we thought that we were coming out of this pandemic, but it looks like we are still somewhat stuck in it. So it's been a very, very interesting 18 months, and I think as appraisers, we are somewhat shocked at how busy we have been, and how our business has run, and then of course how the real estate markets have performed within the last 18 months despite a pandemic recession. So let's talk about a few things. One of the things I found very interesting was to look back at the webinar that I did back in March. I think it was March 22nd of 2020, and back to today. And I'm going to talk about some of those comparisons and where we've come. So I imagine that everybody on this webinar really knows what COVID-19 is by now. And it is the coronavirus and COVID-19 is the type. It is obviously a contagious disease, we know, and it was first identified in Wuhan, China, back in December 2019, and since then has spread worldwide, leading to an ongoing pandemic. Good news on it was that towards the end of 2020, we got various vaccines that were developed and intended to provide some immunity against the virus. And they have proved very, very successful. They are still pending a final approval for the FDA by the FDA here in the US. But I think that we have probably up to about 50% of the population fully vaccinated and are moving in the right direction with that. So good news on that. So back in 2020, March 22, I don't think anyone coming into 2020 had any idea what we were facing. And all of a sudden, March rolls around. I mean, I think we started to hear things in February. And then we realized we were in a pandemic probably mid-March. So I put together that webinar, and the figures I had right then was that there were, which seemed very alarming as of that time, was that there were 332,134 confirmed cases worldwide, with 30,000, just nearly 36,000 confirmed cases in the United States. As of, I think, yesterday, there are 194 million confirmed COVID-19 cases worldwide, with 34.4 confirmed COVID cases in the United States. There have been just over 4 million deaths worldwide and 110,000 confirmed COVID-19 deaths in the United States. I doubt if there's anybody on this call who doesn't know someone who has had COVID, someone who has had COVID very badly, and even someone who has died of COVID. So this has been a long and drawn out pandemic, and it still continues to impact us here in the United States. Now, the initial reaction to COVID back in March was it was pretty swift. We, slammed shut our borders, issued stay-at-home orders, and public life really essentially ground to a halt. And with that, we had some pockets of very, very bad COVID, particularly areas, nursing homes and prisons, and areas like New York City. And there were tireless efforts by healthcare workers to help it. But we then kind of faltered somewhat in our response. We had, a downplaying of the danger and kind of slow testing and inadequate tracing and a confusing mask guidance that allowed the pandemic to grow somewhat out of control. And when you compare it to some other countries, it has been a very sad and long process. So it's what we are working in right now as appraisers. We have a lot of positive things going on. We have vaccines that are proving to be very successful. We have wonderful heroic efforts by healthcare workers. But we do have variants, and it seems that the Delta variant, the most recent one, is it is very catching. I don't know another word. It's very easy to get. It's also incredibly dangerous, and I was very shocked. I live in a fairly small area in a southern state, and 2 or 3 weeks ago, our local hospital had I think less than 20 COVID patients, and then now up to 150 COVID patients. And we don't know how long our vaccines are going to last. Well, we need boosters, and there is, of course, some breakthrough of the Delta variant with the current vaccine, although it looks like it's holding up against serious illness and death. And so most of the I think 97% of hospitalizations are people without vaccines. And then added to that are a group of people that we have, and maybe one of you, and I know I hear this from appraisers and from friends of mine who have long-lasting effects of COVID long haulers, as we say, people who have still have no smell or taste, rippled with tiredness and some damage to the lungs and some of the other things that COVID causes. So it has been a long process to get through it. So with the initiation of the pandemic and the shutdowns and everything else, we had essentially a COVID-19 recession that immediately impacted the country. The stock market fell to the lowest, I think, in something like 14 years, or it might have been even more. And a lot of businesses that were absolutely devastated by COVID. And then, ironically, a lot of businesses weren't impacted. And I thought this was a really good kind of analogy where I saw that someone said the industries that were impacted depended on the movement of people, and the ones that weren't impacted depended on the movement of information. So yeah, there are just some industries: gambling, airlines, hotels, movie theaters, sports, concerts, cruises, shipping, film production, automobiles, oil and gas, retail, tech, conventions, food service, theme parks, all these, gyms, construction, all these industries involve people, people in places, movement of people. We look at our profession, and I think we kind of came through very, very well. And I think that obviously our business relates to the movement of information, the communication of a value to a client. So we were able to succeed. And the real estate industry boomed, as we will talk about. The other thing, you guys are all in different areas, that we have city economies that were very impacted. And we're going to talk about that because we saw movements of people from many cities, urban areas too. So Vegas, Orlando, very heavily impacted because of tourism and casinos and all those kinds of things. Whereas, the tech sites up in Seattle and Northern California were not impacted as much. So it has been a very, very interesting few months. So with that, the irony of ironies is, and I don't think that maybe 18 months ago we would have seen this, but there has been a crazy residential real estate boom, the biggest boom since 2006. And, sales of homes in 2020, just surged to the highest level in 14 years. And a lot of real estate analysts say that pandemic ignited the boom as we saw people moving from one area to another. The realization that people were not stuck in one place to work, especially as a lot of people started to work from home, and that they could live anywhere. And they moved from some of the, New York City, San Francisco for cheaper areas. And you see this kind of growth in those areas. I think it's a very interesting thing. But with that, we just saw a surge of people really concentrating on their homes and wanting to improve where they live. I think that many people who previously went into an office for 8 to 10 hours a day and instead remained at home looked around where they were and said, hey, I'm going to have to work at home. Do I need office space in my home? I want my home to be nice. I want to live and work in somewhere that I appreciate. Instead of being in a 900 square foot apartment, I want to have a 1,500 square foot house or a 2,000 square foot house. So I think this is one of the things that drove that boom in real estate. And there are also some other things at play, that some long-term things that really started to push this real estate boom. And one of those being that millennials were aging into that prime home buying age. They had not really looked at buying homes. And I think there is an incredible age group that moved from renting to buying, and they had a little bit saved up, and I think they really looked at where they were living, as I said, from their apartments or a little rental space, and said, I want a home of my own. So you saw these millennials as first-time home buyers really coming into the market. And then, of course, as we know as real estate professionals, appraisal professionals, the markets were critically undersupplied. there was no new construction going on in this country for a very long time, probably 2008 through to at least 2012 onward. The Great Recession had a horrible impact on the construction industry and builders, and literally nothing got built. I know appraisers who got qualified during this period of time and had never ever appraised a new construction property. And so when you look at several years of no construction, it means that we are critically undersupplied. And then you add on to that, so maybe over 2014 onwards, that homes got built, but now we're looking at an undersupply, and builders cannot build fast enough. They cannot get the manpower, they cannot, you've got timber prices at ridiculous levels. So even though they have actually come down, I think that you still don't have the supply that we need. And then, of course, we've had historically low interest rates. Now, this is a little bit different from how it was, back in 2006, 2007, because at least the mortgage lenders are maintaining high standards. It is not, we don't have these crazy kind of situations where anyone can qualify for a loan, and we had a lot of issues with that. And the other thing with that, we have kept up the level or the qualifications of people coming into the market, but home prices also meant that any homeowner who can't afford their mortgage just sells their properties. Back in 2006, 2007, we had, many of the prices or values were inflated, and people would just walk away from their homes. But when you've got prices going up, instead of walking away in foreclosure, they can simply sell their home. And so we have this kind of crazy situation. And the other thing, I'm sure most of you are homeowners, but collectively in the United States, they look at the fact that in 2020, homeowners gained a total collective $1.5 trillion worth of equity in their homes. And I think this is such an incredible thing for people. I'm very different from a situation that we had back in 2006, 2007, where people owed a lot more than the property they lived in. People now are instantly getting, and particularly in certain areas, are instantly getting equity in their home. So, I bought a home, a new home in 2020. It went into contract in April. By the time my appraisal was done in late in the year, the appraisal came in $50,000 higher than my contract price. And now it's probably more, I don't know, but it's kind of interesting that we are building equity very quickly in homes. And I don't know, can't look into into the future, but I don't think this is going to come down. I think it will stabilize. I think we will have stable values, but I don't think this is going to, we're going to have a decline in values. But as of yesterday, I did hear news that maybe that housing boom has come to an end. Particularly in the new homes, they actually fell 6.6% below May's rate in June, and then that is 19.4% below June 2020. Even though median prices of new homes rose, it wasn't at such a great rate as before. And most importantly, they say that that the inventory of new homes has actually jumped up a month. So we now have a 6.3 month supply in June versus 5.5 in May. So I do think that perhaps we are getting to the point eventually where we might have enough supply. Just driving around, I see that there are more houses for sale, although I do think realtors are selling them quickly and keeping the signs up. But I think some of the craziness that you guys saw earlier this year will start to dissipate, and we will have a leveling off of the market. I think supply will still remain strong. I mean, demand will still remain strong as much as interest rates remain competitive. But I think slowly we'll see that supply start to come up and somewhat of a stabilization of the market. But it has been very interesting in the last 18 months. You don't want to hear my whole thing about realtors, but I think also that there has been somewhat of a feeding frenzy on this too. So anyway, interesting market. So let's go back also something else, because we are going to talk a little about appraiser capacity. And as you guys know, you have been so incredibly busy in the last 18 months. And a lot of things that caused that. Obviously, there was a big refi boom in 2020. That refi boom has gone away, pretty much. I think anybody who wanted to refi has pretty much done so. We're still seeing some refis, but nothing like the rate. The purchase market is a little frozen. So how come you're so busy? What has happened that you guys continue to be busy? So let's talk about that capacity issue. But I think it goes back to early last year. At one point, talking about health dangers and sickness and fear and retirement. At one point last year, we actually had about 40% of our active appraisers, the ones that do work for us all the time, who were sick with COVID. Either sick with COVID, I say sick with COVID, or they were quarantined. I should have put that probably in there, but they were not available for assignments because they were either sick or quarantined. With that, it was hard to inspect properties because borrowers objected to interior inspections. I'm not surprised. There are many people who didn't want anyone to go in to their properties, and they had either they were afraid of the appraiser being sick, and they were, or they didn't want, or they had somebody sick in their building. Many of our appraisers withdrew from interior assignments. They, too much of a risk. We will do exteriors only, but no interior assignments. So take those guys off the eligibility list for assignments, except for exteriors. And then, of course, we had some appraisers who just chose to retire. Can't blame them. They said, enough is enough. I'm done. Let's be done with this. So government obviously and GSEs had some response to this last year, and we're all aware that, I think you're aware, they tried to go with more appraisal waivers. That means that they could close loans, probably mostly on purchases, without an appraisal. I don't see that had a huge impact. And then some flexibilities to move an assignment to a desktop or an exterior. Again, this was not a huge, particularly in our market where we are working with credit unions. We didn't see this, a huge amount of this going on. But it was a fair attempt to try to facilitate the appraisals and get them through earlier. You know, and I think it was confusing to a lot of people. I don't think appraisers completely, uh, you know, kind of got where they were going on this. You know, and maybe and so the communication from Fannie and Freddie perhaps wasn't the best on, you know, the scope and what to do with this. And then, you know, somewhat jerry-rigging of the existing forms to, you know, to be able to do this with you know, a change in the certification. And it was fine, but I'm not sure it was used as much as it could have been, and would have perhaps helped facilitate orders a little better. So let's move to appraiser capacity, and I think this has been the kind of the hangover, for want of a better word, of the pandemic and appraising in the pandemic. This is actually a shot from the from Freddie Mac. Danny Wiley, who's the chief appraiser at Freddie Mac, put out a thing on appraiser capacity, and I really think it shows where we stand right now. So in yellow, we have the number of unique licenses. By unique licenses, we mean that they're not duplicated licenses in another state. So you're working primarily in the state. Now with that, it's a unique license. It either licensed, certified, residential, or general certified appraiser. And as we know, those licenses may be made up of people who never do residential appraisal work. So the volume that you're seeing there, the refinance volume and the purchase volume, is based on what goes into the UCDP. So really any loan that may be any residential loan that may be done, you know, to be sold on the secondary market. So as you can see, licenses since 2013 have remained fairly steady. We haven't lost a lot of appraisers. We haven't gained a lot of appraisers either. We kind of look like it may be just a little less than we had back in 2013, but looks like it's just stayed steady. But you look at that volume in 2020, both purchase volume and refinance volume, and you can see that how the amount of work that needed to be done. And I think the same, you know, basically the same amount of appraisers have to do, I don't know, maybe double the work in some cases. And I think that's incredible. And that's no wonder that there are increased turn times, obviously, and higher fees. So I just think that this illustration really shows where we are. And I think that is even kind of shown more when you look at the actual kind of state by state kind of comparison. And what I would look at, one of our big states that we work in is in Texas. So what this basically says is the amount of appraisals that go at least once into the UCDP per appraiser in each state. So if you look at Texas here, it's basically saying that there are the unappraiser, any individual, now let's qualify this, any individual with an appraisal license in the state of Texas does on average 294 appraisals a year. That number is incredible because there are many appraisers in the state of Texas who never ever touch a residential appraisal, who never ever touch lender work. And so you take out, and I don't know how many they are, but let's say you take out 30% of the licensed appraisers, and the volume for Texas appraisers is incredible, absolutely incredible. And you know, I think these numbers are staggering. In at some point, something has to be done on this. That it has leveled off 2021, but we are still in a hangover from this 2020 volume level. It's absolutely staggering. So the other thing that we saw that happened in 2020 that I think has um, kind of hit the appraisal industry on the side of the head and really is being taken notice of is a focus on racial equality and diversity in the appraisal profession. So this illustration here comes from the questionnaire that was sent out by the Appraisal Foundation early this year. And basically, yeah, there's a lack of diversity in the appraisal profession. 77.6 or 68 of respondents, percent of respondents were white. I haven't got the table here, but I would also say that 65%, I think, of the respondents were male too. So we have 3% Black, 4% Hispanic, and these numbers are just kind of, yeah, there is, you can't argue with them. There is a lack of diversity in our profession. And there are, I know there are many reasons for that. I don't think it's any fault of any appraiser, but I think it is an overall fault of our industry and the way that we operate. I think that hopefully this will be something that we can resolve. It is very upside down in comparison to other professions. For example, if you look at CPAs or attorneys or something else, this is very different from other professions. The other thing that came out last year, and a lot of this resulted, I think, from a lot of the, George Floyd and the resulting social unrest and call for action. But last August, a article came out in the New York Times that really got a lot of sway. Black homeowners face discrimination in appraisals, and it was followed by other similar articles in other newspapers, the Washington Post and some others. Basically, a story where where a homeowner had a property appraised. I think it was a mixed race couple, and it came in below the neighborhood, and they asked for another appraisal, got it. When the next appraisal came out, they removed all pictures of family members, so it came in at a different amount. And with that, there were also some other articles and papers that came out citing disparity between home values in Black and white areas. And the arguments are very strong, very, very strong. And very concerning too, because what this essentially, if values are disparate in Black neighborhoods, it means they have a lack of access to loans, access to wealth, and new businesses don't get started, and a whole bunch, and maybe there are health issues and a lot of other issues relate to this. And obviously, there is a lack of diversity in the appraisal profession. So these are things being looked at right now in our profession, and I think are very, very kind of pertinent to what is going on. So I think that there will be some solutions for us, and some things that will probably make it look different in the future. And I think so one of those will be increased diversity, a scrutiny for racial bias, increased education on potential discriminatory acts. That will absolutely happen. The Appraisal Foundation is working on that. The Appraisal Institute is working on that. They have a joint thing with the Urban League and Fannie Mae to try and encourage young people of color to come into the appraisal profession. So I think that is, you're going to see that we will have more education on racial bias, and there will be an increased focus on that from our clients and from the GSEs and the government on that. So don't be shocked, it's going to come. Now, the other thing with the, what has happened as far as appraiser capacity is we are going to see higher fees. We're already seeing higher fees. I think that is fair as long as it's not a knee-jerk reaction. I think it's probably been a long overdue kind of thought that the appraiser fees should go up. What I don't like to see is knee-jerk reactions, just people kind of, what I say, giving the go-away fee. But I think systematic increasing of fees will happen, and it should happen. I think there will be a coordinated effort to reduce appraisal turn times. I'm not sure that the market is ready to see, they don't want 6-week, 2-month, 3-month turn times. And so we will see the powers that be trying to reduce that turn times. With that may be an increased use of appraisal waivers. I don't know that, but I think that at some point, the mortgage industry and realtors are going to say enough is enough. We can't have these kinds of turn times. How can we push the appraisal profession to shorten these turn times? What we do internally as a company is we kind of say to our lenders, if you need it quicker, you're going to have to pay a rush fee. So that fee, but that's not a long-term solution, and there has to be a long-term solution to decreasing those appraisal turn times. And so the other thing I think that probably will help with that is a modification of appraisal forms. Now, having said that, no one's really decided what Fannie and Freddie are doing. They're still in conservatorship, so and they have put off any kind of modification to those forms because of that. The latest I heard was that they are not actually changing the form, they're just changing how you will complete it. So I think it will become, I've said this before, more of a kind of like, I don't know, TurboTax kind of thing. So that instead of you completing it, in an old-fashioned way of filling out the form, you'll be asked questions and that kind of thing, just to speed it up. We are going to see some changes to appraiser education and licensing requirements. The biggest thing I think will be that part, if not all, of the experience requirement will be able to be done, I guess, from through distance learning, and will not require a supervisor or even a client, for that matter. That people will be put into situations that they won't be able to do it without that. The technology they call, what's it called? I can't remember what it is, but I think that they will do that a lot more, that you basically will, as a trainee, will run through scenarios without actually physically going out to a property and having a client and having a supervisor and those kinds of things. So interactive kind of technology. So I think that will happen. I think we're going to see more retirements. This has been a bruising, hard 18 months. I think that many people have decided that enough is enough, although it's been good money. And so maybe that's it. They've made enough money in the last 18 months and say enough is enough. I'm done. And I hope that we see younger appraisers. I hope that our profession can transform to younger appraisers, and that we are able to provide the mechanism to bring those younger appraisers and diverse appraisers and people of color and women and make this a profession that young people right out of college want to do. I think it is a great profession, but it's really difficult to get into, right? And I think we've got to make the access to becoming an appraiser still academically sound, but we have to remove some of the barriers. And the biggest barrier probably is that supervisor trainee barrier that we have right now. So anyway, that is a webinar. We are at about 40 minutes, which is good. I try and get done in about 40 minutes to 45 minutes to allow you guys to get back to work. My email address is scarruthers@treeunion.net. Would love to hear from you. I would love to have your thoughts on the last 18 months and what you see as the future of the appraisal profession. We really enjoy input, and we enjoy working with all of you guys. We try and do things a little differently. We are very pro appraiser, and we want you guys to take care while you're out there, and thank you for everything you do. So with that, I will pop off here and say goodbye, and thank you for joining us.